Okay, let's just dive right into this high-octane revision explainer. We're going to bulletproof your ACCA BT1 exam technique today. Look, if you're preparing for business and technology, you already know that financial statements can feel, well, kind of like a minefield. The examiner isn't just checking if you've memorized the book, they're testing your absolute precision. So today, we're strictly focusing on the financial statements module from the ACCA BT notes. We're going to break down exactly what you need to know and, more importantly, the traps you absolutely need to dodge.
I need your absolute focus right now. We're going to sprint through the exact traps the examiner is literally just waiting for you to fall into. We'll strip away all the fluff, focus on the high yield concepts, and basically build this strict logic that you can apply to every single scenario question they throw your way. Sound good? Let's get to it.
All right, level one, the vocabulary, securing the foundations. We literally cannot conquer the statements until we master these building blocks, so let's lock down the vocabulary right now. Let's strip these definitions right down to their core timeline. Honestly, don't overcomplicate it. An asset? That's simply a resource you control right now that's going to provide some future economic benefit. Think of it like a tool, machinery, inventory, or cash that helps you generate income tomorrow. A liability, on the other hand, is a future obligation. It's this heavy responsibility hanging over you that guarantees an outflow of your cash down the line, like a bank loan or having to pay your suppliers. So, if an exam scenario mentions a future benefit, boom, the answer is asset. A payment obligation? Yeah, for sure, that's a liability. Now, let's contrast those items with your day-to-day operations. Revenue is basically the lifeblood of the whole thing. It's the income you earn from your normal, everyday activities, like making sales or doing client services. An expense, though, is the unavoidable cost you have to incur strictly to generate that revenue. We're talking rent, electricity, paying your staff. The exam trap here is super simple. If a scenario asks about income from operations, you know that's revenue. If it asks about the cost of running the business, that's your expense. But hey, you really gotta watch out for a massive exam trap here, confusing a cost with an expense. Seriously, memorize this golden rule. Cost becomes an expense when it's actually used. So what does that mean in plain English? Well, the money you spend to buy a massive machine, that's just a cost. But the electricity you burn to physically run that machine day in and day out, that is the expense. You've got to keep that distinction crystal clear. So you might be wondering, where does the owner's skin in the game actually fit into all this? Well, that is your capital. It represents the owner's investment and their ultimate claim on the business. Now, remember this, and this is huge. When you see a scenario talking about an owner's investment, absolutely do not classify it as a liability. A liability is an obligation owed to outsiders. Capital is what the business technically owes back to the owner themselves. It's a subtle distinction, but trust me, they love testing it. Okay, and what do we get when we subtract all those everyday expenses from our operational revenue? We get profit. Profit is simply your revenue minus your expenses. It's really your main indicator of performance. It shows your actual earnings after all the costs of earning that revenue have been completely deducted. Moving on to level 2, the core equation, smashing the terms together. Since we've got our vocabulary absolutely locked in, let's smash those terms together to reveal the core formula of all accounting. Right here, this is the accounting equation. It's basically the absolute law of gravity in BT. Assets equal capital plus liabilities. Think about the core logic for a second. Your business has resources, which are your assets. But those resources didn't just magically appear out of thin air, right? They had to be funded by someone. They're either funded by the owner, which gives us capital, or they're funded by outsiders, which gives us our liabilities. You might also see it flipped around a bit. Assets minus liabilities equals capital. Same exact logic. Let's step right into the examiner's minefield. Literally every single transaction impacts this equation, and the scales must always stay perfectly balanced. So picture this. You take out a bank loan, your cash asset goes up, great, but your liability, the loan you now owe, must also go up to match it. Or say an owner invests their own personal cash into the business. Your cash asset goes up, but so does your capital. See? The balance is never, ever broken. The absolute most common mistake I see students make is updating just one side of the equation and completely forgetting the other. It happens all the time. If an asset increases, you absolutely must look for an increase in either a liability or capital, or maybe a corresponding decrease in a different asset. You've got to vigorously check that the balance is maintained in every single scenario.
Honestly, keep this one-line summary echoing in your head during the exam. Assets always equal funding sources. It's that simple. If you remember this foundational logic, you're going to effortlessly navigate any transaction impact question the examiner throws your way. Okay, level 3, the final product, decoding financial statements. Let's take all these building blocks we've discussed and see how they actually form the two primary financial statements you need to know for BT.
Notice the highly tested distinction between your two primary statements here. It all really comes down to timing. The statement of financial position, or the balance sheet, is literally a photograph. It's a snapshot of your assets, liabilities, and capital at one single frozen point in time. The income statement, on the other hand, that's more like a video. It measures your revenue, expenses, and your ultimate profit over an entire period, like a whole month, a quarter, or a year.
So if a scenario asks you which statement shows position, the answer is definitively the balance sheet. If it asks which statement shows performance, the answer is the income statement. The crucial takeaway to lock into your brain is just this simple trigger. Position equals balance sheet and performance equals income statement. Don't overthink it. All right, here we go. Boss level, the cash versus profit trap. You've made it to the final boss level of this explainer, and we're facing the single most lethal trap in the entire BT financial statement syllabus. Let's do this. The examiner loves to present this scenario. A company's profit is absolutely soaring. It looks amazing, but their bank account is completely empty. And then they'll ask you to explain why. Seriously, think about it. How can a business earn a massive profit but have absolutely zero cash to show for it? Well, this is the deadly credit sale trap. Imagine you land this massive contract and you make a huge sale on credit today. Now, because of accounting rules, the accruals and matching concepts, you are strictly dictated to record that revenue immediately. So, boom, your profit shoots straight up on paper. Looks great. But in reality, your client hasn't actually paid the invoice yet. They still owe you. That delay is what we call a timing difference. And man, it creates a massive illusion of wealth. Please never, ever assume profit equals cash. Profit is just an accounting concept. It's this somewhat artificial figure calculating using rules and accruals. Cash, though? Cash is cold, hard reality. It's the physical, undeniable truth of your bank balance. A super common mistake students make is just assuming profit and cash move in perfect sync. They absolutely do not. And ignoring this massive disconnect is easily the fastest way to lose marks. Look, if you take absolutely nothing else away from this explainer today, let it be this. Profit is accounting. Cash is reality. Say it with me. When a scenario describes a business that looks incredibly healthy on paper but somehow can't pay its bills, immediately, and I mean immediately, start looking for credit sales and timing differences. All right, you now know the traps. You're armed with the exact logic needed to totally dismantle the examiner's tricks. You know the vocabulary, you understand the balancing act of the equation, you've got the distinct timings of the statements down, and you see right through the deadly cash versus profit trap. But here's the thing, knowing the traps and surviving them under intense exam pressure, those are two very different things. When you finally sit down for that exam, will you see the matrix, or are you going to fall for the illusions? Time to dive into those practice questions and prove it. You've got this.